Today we're going to talk about second VA use. Can I get a second VA loan when I already have a VA loan? Not that I had one in the past and I paid that, sold that home, I paid off that mortgage, I no longer have a VA loan. This is a situation where you have an existing VA loan. You own a property, let's say it's your current primary residence, and it's financed with a VA loan, and you want to go buy a new primary residence because that's all you can do with a VA loan. You can only buy a primary residence. But can I get a new home with a VA loan without paying off the existing loan? The short answer is yes, but it's a qualified yes, because not everybody can do it. You do have to have some remaining entitlement, a partial entitlement available to do that. Now, what are some of the reasons that you would want to do that? What are some of the circumstances that would require you to use your VA again while your existing loan is still in place? Well, the kind of a partial entitlement that you would have left to buy a new home. Well, the most obvious and the most common is probably to buy a new primary residence. That's this one right here. You buy a new primary residence. Let's say you bought your house many years ago and you're just ready to move up. You've had that house for many years, your family's grown, your income's grown, you're ready to move up, you want to buy a new home, but you don't want to sell your existing home. You want to retain it. That's okay. Some people don't understand that, but that's okay, because essentially you're going to have a VA loan on an investment property when you leave that home and turn it into a rental, and that's perfectly okay. But you just need to make sure that you're buying the new home that you're buying with the VA loan is also going to be a primary residence. So let's say that's your situation. You want to buy a new primary residence. That's one of the most common situations. And the obvious thing is, let's say you're moving to a different part of the country. There's no question as to which one's going to be primary. Your job's moving, you have to move, you're buying a new primary. Underwriters aren't going to wonder if, are they really kind of buying an investment property and just calling it primary so that they can get the better financing? Now, if you're staying in the same area, underwriting is going to have a few more questions just to make sure that they're comfortable, that the story is reasonable. But as long as it's true, as I like to say, underwriting questions are few, right? Tell the truth and then tell your story, and underwriting is going to perceive that and be able to document that. So you can do that. You can buy a new home, a new primary residence, without paying off your old VA loan and hold on to that property. And that's one of the situations, probably the most common situations, where you're going to need a second VA loan. Now, generally, you're not going to be able to finance 100% of that second home that you buy with an existing VA loan in place. And that's because your entitlement is encumbered by the previous use. But what's probably true, or often true, is it's not 100% encumbered, that you still have some available VA entitlement that you may want to use. And that's really what this video is about. The other reasons maybe is, maybe you let your loan be assumed. You sold a house in the past that had a VA loan on it and somebody assumed that. And let's say it's a situation where it was not a veteran. Someone assumed your loan. A non-veteran can assume a VA loan, but they're not allowed then to substitute. They don't have any of their own VA entitlement to substitute for yours and restore your entitlement. You can sell your home to a vet and they can then substitute their own entitlement, potentially. There's a process to go through. They can substitute their own entitlement for your entitlement and fully restore your entitlement. So you can have that situation happen, but you can also have it where your entitlement is not restored and it's still encumbered. So you go to buy that next house, and even though you've sold that house, you don't own it anymore, that mortgage is still out there encumbering your VA entitlement. And that's another situation where you might want to use whatever partial entitlement you have left. And then kind of the last one that I want to highlight here is, like, if you've had the unfortunate circumstance where you had a foreclosure on a property, you had a VA loan on that property. The VA loan, the VA guarantees that loan, and they make good to that lender a portion of that loss or all of the loss, depending on how much that was, and that becomes a encroachment on your future entitlement until you restore that. If you never restore that, that always remains an encroachment on your entitlement. It's there, but even in that situation, you may be able to get a new VA loan, assuming that you've waited out I think it's a 2-year waiting period with a foreclosure on a VA, but you may be able to get another VA loan because you still have partial entitlement left. Just because you had a foreclosure doesn't mean that that foreclosure fully uses up your full entitlement. So let's do the math a little bit so we can kind of understand this a little bit. So let's say that here you have your basic entitlement, and the secondary entitlement is just, this basic has stayed fixed forever. And the secondary entitlement is just basically whatever it takes to get you up to whatever 25% of the county limit is. Now, right now, the county limits aren't necessarily relevant for purposes of VA purchases if you're not talking about second use. What we're talking about now is second use. But as most of you know, and I think it was in 2019, the VA rules changed where you can finance 100% regardless of the purchase price as long as the lender will do it. All the lenders have their own limits, how high they'll go. But the county limits no longer limit lenders on how much they can finance. You can buy $1 million, $1.5 million, $1.5 million property with a VA loan, 100% finance, if it's your only use at the time. But if you're looking at second use, then that's when these county limits do come into play. So the Federal Loan Financing, Federal Housing Financing Administration, FHFA, sets the Fannie and Freddie loan limits every year. And right now, nationwide, it's $726,200. That's all across the nation, every county across the nation. But let's say you live in a high balance county. Now, by the way, this calculation works if you're not in a high balance county. You still just have to do the math, see how much you used when you first bought your property, how much is left, and whether it's useful to you in your new purchase objectives. But I'm just going to use an example from my county. Let's say I'm in Snohomish County, Washington, and it's a high cost county, and so the federal limits for the county limits for our county is $977,500. And so the total entitlement for purposes of VA calculations is 25% of the county limit, or $244,375. And so this secondary entitlement really is just whatever the plug is to get to this $244,755. This isn't even factored in any kind of subsequent calculation that we're going to do in and of itself. It's really only relevant there to show that, look, this is basic entitlement. This is how much it takes to get to the full current county entitlement, $244,375. Now, let's say that you bought your existing house years ago and you paid $450,000 for it. So the entitlement charge is, let's say, 25% against that one. Now, this is based upon the original purchase price, and 25%. That assumes you financed 100% of it when you bought it. And so you used 25% or $112,500. And that's what currently sits against your entitlement. That's how much of your currently available entitlement has already been used, is not available to you. Well, we just did the calculation based upon, here's my county, 25% of that is $244,375. So here's the total entitlement you have available. That's today. And so if you take the total entitlement less what you used when you bought the house, you've got $131,000 left over. And this is where the math gets a little bit tricky. Sometimes these calculations are hard to follow. But basically what that means is you could buy a house for 4 times this amount, right? Because that means 25%. 25% of $527,500 would fully use your remaining entitlement. So you could buy a house up to $527,500 with putting 0 down, and then you would have 2 houses that you financed with VA with 0 down. But what if you want to buy a house that's more than that? That doesn't mean you can't do it, right? You can still do it, but you have to make a down payment. And here's kind of the beauty of how this works is you don't have to make a down payment. The full difference between the purchase price that you could finance with 100%, with 0 down, and whatever you're trying to get to. Here's how the math works on this. Here's the new home you want to buy, and let's say it's a $750,000 purchase. Well, we just saw down here the max price you can finance with 0% down is $527,000. That just came from here, $527,500. That difference is this, $222,000. You might naturally think, okay, then I have to bring $222,500 to the table, but that's not the case. You only have to bring 25% of that amount as a down payment. So in this case, your new house you want to finance at $750,000, and you're going to have to bring a $55,000 down payment. And so, that's depending on your specific situation. Now, you got to always remember, VA, they don't have mortgage insurance, and so that's a nice benefit. Interest rates tend to be lower, but there is this funding fee. There's this funding fee here that's shown in this chart, and that can be fairly significant. And that's that's going to just have to factor into your considerations as to whether or not VA is the best option for you or not. What are my other options to finance this new home with the amount of down payment that VA is going to require me to have in there? Now, many of my clients have some partial VA disability and they're exempt from the funding fee, and that makes VA kind of a no-brainer in their situation because the interest rates are lower. If you don't have to pay the funding fee, then it really is a really sweet deal. But even with the funding fee, sometimes it's because the down payment's lower, because there's no monthly mortgage insurance. It's still going to be a good deal to do, but understand that always in the scenario that we're talking about here, we're talking about second use. So you're not going to get these first use rates, you're going to get the after first use. But the other thing to keep in mind here too is you're almost invariably going to be making a down payment. Now I know we showed a situation where you don't have to make any down payment to buy the new house if you're buying at a level that is at or below what the calculation shows that you can buy with zero down. In this case, it was the 527,500, right? But here, most of the time when you're using second use, you're going to bring some kind of a down payment. And so here you see the funding fee goes from 3.3%. If you put less than 5% down, if you put at least 5% down, you're at 1.5 funding fee. And that's to get very reasonable. Right, then that starts to make VA, again, very, very attractive loan. So think about that. This is just meant to kind of show you that, yes, it is possible. Feel free to reach out, give me a call if you have specific questions that you want to ask about how to do that. Please do, if you like this video, if you like my channel, please do subscribe, like me, leave me reviews, ask me questions. I'm always happy to reach out. I'm licensed in Washington, Idaho. But many of these things apply across the nation, and I'm always happy to answer your questions, even if I'm not licensed there, and also maybe help you find a good qualified, quality broker in your area as well. Thanks so much, and we'll talk to you next time.